90% of the world's millionaires built their wealth through real estate. Not stocks, not crypto, not a lucky business exit. Real estate. And the interesting part is, they all used the same formula. A formula most people have never been taught. By the end of this video, you will know exactly what that formula is. And more importantly, how to apply it starting from where you are right now. Stay with us, because at the end, we are going to show you the one number every serious investor calculates before buying any property. Most buyers never run this number, and it costs them everything. First, let us understand something important. Wealthy people do not think about real estate the way most people do. Most people think about real estate like this. Find a house you love. Buy it. Hope it goes up in value. Wealthy investors think about it completely differently. They ask one question before anything else. What does this property pay me? Not what does it look like? Not what does the kitchen look like? What does it pay me? That single shift in thinking is the foundation of the entire formula. The formula has 4 parts: find, fund, fix, flow. Every successful real estate investor follows these 4 steps in this exact order. Let us break each one down. Step 1 is find. This means finding the right property at the right price. Not any property, the right property. Successful investors are not looking for pretty homes. They are looking for undervalued assets. Properties priced below what they are actually worth. Distressed sales. Estate situations. Properties that need cosmetic work but have great bones. The deal is made when you buy, not when you sell. If you overpay on the way in, you have already lost before you even started. Buy below market value and you are ahead before you do anything else. Step 2 is fund. This is where most beginners get stuck and give up. They think they need to have all the money themselves. They do not. Wealthy investors almost never use only their own money. They use leverage, bank loans, private lenders, partnerships, government-backed programs with low down payments. The goal is to control a large asset with a small amount of your own capital. A $50,000 down payment controlling a $300,000 property. That property earns returns on $300,000. Not just on the $50,000 you put in. That is how ordinary income creates extraordinary wealth. Not by saving harder, by deploying capital smarter. Step 3 is fix. This does not always mean a full renovation. Sometimes it means a deep clean and fresh paint. Sometimes it means updating fixtures and landscaping. The goal of the fix step is simple. Force appreciation. Appreciation that happens naturally over time is great. But forced appreciation is better because you control it. You buy a property worth $200,000. You spend $15,000 on targeted improvements. The property is now worth $250,000. You just created $35,000 in equity with $15,000 of work. That is not luck. That is strategy. Step 4 is flow. This is the payoff. This is where the property starts working for you instead of you working for it. Flow means cash flow. Monthly income that arrives after every expense is paid. Mortgage, insurance, property taxes, maintenance, management fees. Whatever is left after all of that is your cash flow. Even $200 a month in cash flow per property does not sound exciting at first, but multiply that across 5 properties, 10 properties, 20 properties. Now you are looking at $2,000 to $4,000 a month arriving without you trading a single hour of your time for it. That is the flow stage, and it is why real estate builds generational wealth. Now here is the number we promised you at the start. The one number every serious investor calculates before buying anything. It is called the cap rate, capitalization rate. Here is how you calculate it. Take your annual rental income. Subtract all your annual expenses except the mortgage. That number is called your net operating income. Divide your net operating income by the purchase price of the property. Multiply by 100. That is your cap rate expressed as a percentage. A cap rate of 5 to 8% is generally considered healthy in most markets. Below 5%, and you are probably overpaying for the income the property generates. Above 8% could mean a great deal, or it could signal higher risk. Run this number on every single property before you make an offer. Every single one. This one calculation has saved investors from more bad deals than any other tool in existence. So why does real estate keep creating millionaires decade after decade? Because it stacks advantages no other asset class can match. You earn monthly cash flow while you hold it. You build equity as the mortgage gets paid down. You benefit from appreciation as the market rises. You gain forced appreciation through improvements. You get tax advantages most investors never fully use. And you do all of this using leverage so your returns are multiplied. No single stock does all 6 of those things simultaneously. No savings account does any of them. Real estate does all 6 at once. That is why the formula keeps working. That is why 90% of millionaires keep choosing it. Find the right property, fund it with smart leverage, fix it to force appreciation, flow from the cash it generates. That is the formula. Simple to understand, takes discipline to execute, but completely learnable by anyone willing to put in the work. If this gave you a new way of looking at real estate, subscribe for more. Every week we break down the exact strategies and concepts that actually build long-term wealth. No fluff, no hype, just the formula. And that's real estate investing explained in simple terms. The goal is not just buying a house. The goal is buying an asset that can produce income, grow in value, and build wealth over time. But remember, real estate can make you rich, or it can bury you in debt if you buy the wrong deal. If you want to learn more about money, investing, and building wealth step by step, subscribe to the channel and watch the next video.